All right, let's jump right in. Today, we're staging a financial face-off between two real heavy hitters in the retirement world, the MYGA and the traditional fixed annuity. We're going to break down exactly what they are, how they tick, and figure out which one might be the right champion for your portfolio.
So, let's start with the big one, the question on everyone's mind. Are you looking for a way to grow that retirement nest egg, but, the wild ups and downs of the stock market just aren't your thing? You want stability. You want guarantees. You want to sleep well at night. If that's you, you're in exactly the right place. Because today, we're not just looking at one solution. We're digging into two really powerful options that are designed to do just that. Now, they both live under the fixed annuity umbrella, but trust me, they've got some crucial differences that we are about to unpack.
First up in the ring, let's meet the MYGA. That stands for Multi-Year Guaranteed Annuity. I kind of like to call this one the predictable planner, and you're about to see exactly why.
Okay, so here's the core idea. A MYGA locks in a single, fixed interest rate for a specific chunk of time. Could be 2 years, 5 years, maybe even 10. And during that entire time, your rate does not change. I mean, not one bit. It doesn't matter what the economy does. It's all about that locked-in predictability.
The easiest way to think about a MYGA is to compare it to a CD you'd get from a bank. You put your money in, you get a guaranteed rate for a set term. Simple, right? But, and here's the kicker, that growth inside the annuity is tax-deferred. That means you don't pay taxes on the earnings until you actually take them out. For long-term savings, that can be a huge advantage.
Of course, there are always trade-offs, right? The pros are super clear. You get that predictable, guaranteed growth, it's tax-deferred, and honestly, MYGAs often have higher initial rates than their traditional cousins. But on the flip side, the cons are all about access. Your money is tied up for that term, and if you need to pull it out early, you're going to face some surrender charges. And also, that great rate you locked in, well, it's not guaranteed when it's time to renew.
All right, time to bring in our second contender, the traditional fixed annuity. So if the MYGA is the predictable planner, think of this one as the flexible adapter.
So here's the key difference. With a traditional fixed annuity, the interest rate can actually change. Usually, the insurance company will set a new rate every single year after the first one. But, and this is really important, you always have a safety net. There's a guaranteed minimum rate, a floor that your account will never, ever drop below.
And that's really the whole idea right there. You have a floor, a safety net that protects you, period. But unlike the MYGA, your rate isn't set in stone for the long haul. It can move around year to year based on what the insurer declares. You're basically trading some of that absolute predictability for a different kind of flexibility. And when you look at the pros and cons here, you can see that trade-off in action. The huge pro is that guaranteed minimum rate for the life of the contract. Plus, you have the potential to benefit if interest rates rise down the road. The cons? Well, your rates could drop after that first year, which means your growth is just less predictable compared to a YMGA.
Okay, we've met our two contenders. Now it's time for the main event, the head-to-head comparison. Let's put them side by side and see how they really stack up in this financial showdown.
Listen, if you take away just one single thing from all this, let it be this right here. The core difference is actually pretty simple. With an MYGA, your interest rate is locked in solid for the entire term. With a traditional fixed annuity, that rate can change each year after year one. That's it. That's the fundamental choice you're making.
This table really breaks it all down. The rate type tells the big story, completely fixed for the MYGA versus one that can change for the traditional. And this flows right into who it's ideal for. If you want totally predictable short to mid-term growth, like for a 5-year period where you want absolutely zero surprises, the MYGA is a perfect fit. But if you're playing a longer game and you want that guaranteed floor but are okay with your rate adjusting, maybe to catch rising interest rates in the future, the traditional annuity just makes more sense.
Now, before we pick a winner, let's talk about something really important that they both have in common. With both of these products, your principal is protected from market risk. You are not invested in the stock market. So if the market tanks, your account value doesn't. That is the shared foundation of safety that both of these are built on.
So, with all that on the table, we've made it to the final round. How do you choose your champion? Well, it all boils down to what you, the investor, are really looking for. It really just comes down to two clear paths. Path number one is the MYGA. This is for you if you value that CD-like stability and you want a rate that's completely locked in and predictable for a few years. Then there's path two, the traditional annuity.
This is perfect if you want that guaranteed safety net, but you're cool with the rates changing each year for the potential of future growth.
This chart really puts it all into perspective, doesn't it? The core trade-off is between predictability and flexibility. A MYGA just goes all in on predictability. You know exactly what you're getting, no questions asked. A traditional fixed annuity, on the other hand, trades some of that certainty for more flexibility, hoping to adapt to whatever the future holds for interest rates.
And hey, one last practical thing to keep in mind. Whichever path seems right for you, both of these are super flexible tools for retirement. You can fund them with money from IRAs, 401k rollovers, and other regular savings accounts.
So we're going to end with a question that really only you can answer. When you think about your retirement, your financial future, what do you value more right now? Is it the absolute locked-in certainty of knowing your exact return? Or is it the flexibility to adapt over time, all while being protected by a guaranteed floor? The right answer depends entirely on your goals, and we hope this helps you find it.